Well, the budget rollout continued today with the federal government announcing a new measure to help make home ownership more affordable.
A big part of qualifying for a mortgage is ensuring you can pay the monthly costs that come with it. For many younger Canadians, these costs are a significant barrier to home ownership. Effective August 1st of this year, we are allowing 30-year amortizations on insured mortgages for first-time home buyers purchasing newly built homes.
So how does that save a homeowner money? Well, let's say you buy a home for $750,000. You make a down payment of $50,000 and you borrow the rest on an interest rate of, say, 5%. If you pay that back over 30 years instead of 25, your monthly mortgage payment will be about $350 less. But that means your debt will last an extra 5 years and you'll pay much more in interest. This is just one of many proposals made this month by the Liberal government to address the housing crisis. And here to discuss the impact on supply is Kevin Lee, the CEO of the Canadian Homebuilders Association. Kevin Lee, it's good to speak with you again.
Great, thanks for having me. Good to see you.
When we last spoke, we said we'd have you back after the budget if this got announced. And here it is before the budget and it's announced. You had called this a game changer and the biggest thing you wanted to see. How will this change the game in your view?
Yeah, it's really important because, we need a holistic approach to address housing affordability and housing supply. And one of the big pieces of the puzzle that hadn't been addressed was some pretty restrictive mortgage rules that we've had over the past decade. Really, they've been getting tighter and tighter. And so it's been harder and harder for especially first-time buyers to get into the market. So this ability to move to 30-year amortization periods really increases the buying power of first-time home buyers who have been locked out. And so, when you get 9%, give or take, more buying power from a 30-year amortization period, that can be the difference between you getting into the market or not, being able to leave your rental unit, which frees up more rental units for people who do need them. So, and it'll spur more construction, which is exactly what we need, because frankly, if we don't have buyers, we can't build homes. So it's a big step in the right direction and something we've been calling for a while.
So explain to me exactly how that works, because this is for first-time buyers, so that it's a subset of the real estate purchasing market. And it's only for new builds. So the idea there is that stops it for the extra buying power from juicing the prices of the resale market of existing homes. But how does that automatically spur extra supply? I mean, certainly, and at a rate that a first-time home buyer wants to get into the market at that entry-level home price.
Yeah, exactly. Well, I mean, we certainly have lots of product that could be available and could be built that could meet the needs of first-time buyers. As I said, if they had a little bit more purchasing power. And so this will really do that. We saw, it was back in 2012 when we used to have actually 30-year amortization periods for first-time buyers on insured mortgages. And, when it moved from that 30 down to 25, it just really cut out a lot of would-be buyers. And then since that time, it's gotten worse. And so by those buyers being able to enter the market, we will see a response from the market in terms of new supply. And it's exactly as you said. I mean, we had some people who are concerned about 30-year AMs across the board, increasing costs and price in the existing housing market and the resale market. So by restricting it just to new construction, you don't have that impact on existing housing and price acceleration, because as you said, you're juicing that market. Now, CMHC has also done the assessment on that and figures prices would only go up 1 to 2.4% if it was across the board. But by this way, you're really being laser focused on providing new supply.
There still is a risk, though, for people taking on longer amortization periods, right? And longer borrowing costs. From a month-to-month cash flow basis, it's easier, right? It lowers your costs, but you do pay more interest over a longer period of time. And if rates were to go up, this could also affect things. And then there's retirement saving implications. I mean, what about the potential knock-on effects of that?
Well, I think the thing we really need to recognize when we start talking about that is we're talking about first-time buyers. Most first-time buyers will frankly be in the mortgage market for 30 years or more because this is their first home. And most homeowners do end up in a move-up home and do end up refinancing and getting, another mortgage. Ironically, you can already get an uninsured mortgage for, 30 years or more already. So this is really making it possible for first-time buyers to get that foothold into the market. The other thing we know is Canadians pay down their mortgages typically faster than their full amortization period. The average time for a 25-year to be paid off has actually been 18 years over time. So, through accelerated payments and that, you really can get there. And if mortgage rates go up at time of renewal, again, first-time buyers, typically their household income is increasing over the period. If you have a 5-year or a 5-year term, I should say, by the time that 5 years is up, probably your household income has gone up. So, home ownership isn't risk-free, but it's also very, very low risk, a lot lower risk than people talk about. Our mortgage arrears rate are at historic lows still right now, despite everything that we've gone through economically.
What does this do in terms of unlocking new builds, though, Kevin? Because, I remember when the GST was removed on purpose-built rentals, that got a number of projects that have been sitting there in the approval stage over the threshold for profitability, and a lot of units went ahead. What's your sense of the inventory waiting to be built, or the potential inventory waiting to be built, that this can affect?
Well, when we haven't done the analysis on it, we've been calling for this for a while.
Yep.
So we haven't done the analysis again more recently, but when we did it in 2020, we estimated that this could bring another 34,000 buyers into the market. So it's pretty substantial.
But supply, like demand I get, but in terms of supply, right? Because you bring 34,000 more people into the market and you don't have homes that qualify as new homes for them to buy, it doesn't solve anybody's problem, right? So in terms of spurring people to build.
Oh yeah, but at this point, you're not building if you don't have buyers, right? So you're talking about the ability of first-time buyers to come into the market, get a pre-construction mortgage with a financial institution that is insured, and now we can actually build the home. So it really is 100% aimed at creating new supply.
Okay, but as a final point, I saw a statement from your organization today talking about the incredible volume of workers you need. This still seems to be the big challenge. So if you have suddenly 34,000 people who can enter the market, who need 34,000 newly built homes, that's a pretty big chunk of the homes we're expected to build as a country on an annual basis, which is way below where we need it to be. So where do you need to get the labor market for home builders for any of this to work?
Yeah, well, I would say right now with we built 271,000 or had 271,000 starts in 2021. And so, last year we were down around 240, and this year it would have been lower, but hopefully with these changes, it's going to come back. So I would say we have sort of capacity to get going on all of this, but there's no question if we're going to do much more than that, we've got 20% of our workers retiring over the next decade at a time when we're trying to double. So, we need more solutions on the immigration front. We need more young Canadians to choose residential construction as a career path. And we are also working on the productivity side and how do we get more factory-built solutions moving forward? How do we de-risk the investment in more factory-built solutions so that we can, increase productivity, because it's going to be tough. That report that came out basically said that we would need to double the number of workers in the industry, and that's a pretty tall order. Yeah. So we'll need productivity advancements as well.
Okay, just as a final question, help me understand the order of magnitude of what this mortgage amortization does in terms of what it might mean for new builds. Like I know your analysis is a couple of years old, but you say 34,000, maybe new buyers potentially. So let's use that as a baseline. On the other side, does that unlock, do you think, 10,000 new builds, 5,000 new builds, 20,000 new builds? What do you think the potential is for that?
Well, because, we looked at the 34,000 and said, well, if this is all now applied and only eligible for new construction, you should be able to turn that into pretty darn near close 34,000 new units if we can get moving. Now, it takes a little bit of time to build them, but if we can get those starts underway, we should be in good shape.
Okay, so you think it could be a 1-to-1 ratio or pretty close to it?
Should be.
Okay, all right, interesting stuff. Kevin Lee, CEO of the Canadian Homebuilders Association. Thanks for joining us again. I have no idea if there's going to be more surprises in the budget, but we'll give you a call if there are.
Oh, perfect. All right, thanks. Good to talk to you.
Thank you.